What's going on, everybody? Welcome back to Wealth Webinar. We do this show every single week in an effort to teach you how to take back control of your money and how to be your own bank, which is exactly what we're going to do today. But this one's going to get really personal because this is my mom. Now, for any of you that know my story, my mom, she always has been there for me. She's been my unconditional one. But my mom has always been the person that just gets by. She still lives in the same house I grew up in, a 2-bedroom, 1-bathroom. It's about 900 square foot with the sunroom on it now, but it used to be 700 square foot house. Nothing to write home about, but it's cute and it's home. But my mom's always just gotten by. She's always not made a lot of money, just enough to pay the bills, keep the roof over her house. Her house is now paid off. Really excited about that. But cars have always been a struggle for my mom. And my mom has always had to drive a car that fit her budget, which is perfectly fine. I think that's the case with all of us. But my mom loves Chevy Equinoxes, and my mom has been leasing cars now for I don't even know how long. We got this nice guy down there at one of the dealerships. His name's Brian, and he's always taking care of my mom. Now, the reason my mom always leases, or has for as far back as I can remember, is because the payment's the cheapest. She gets to drive a new car that doesn't have any maintenance, and that's what she likes. Risk-free. She doesn't like, having the risk of her car breaking down or this, that, or the other thing. I remember when her last lease came up, I said, Mom, you have to be your own bank. We can't do this stuff anymore where you're leasing. And the dealership said, oh, she brought her car. How that all happened is she brought her lease in to get the brakes done. It was 6 months prior to the lease expiration. And they're like, oh, your brakes are shot. You're going to get in a car wreck and, you could have an accident. This is how they play the game. And she's like, oh my God, Chris, I can't drive this car ever again. I need a new car. So, they sat her down. They were talking to her about leases. I get called up. Hey, Chris, can you look at this? I don't know anything about this stuff. And I'm like, look at what? And she said, I'm going to probably lease a new car. My brakes are shot. I said, no, Mom, you got to be your own bank. And it got into this whole thing. And anyway, long story short, she won that battle. We leased that car, but I won the battle for how long? I said, Mom, you're going to do a 2-year lease max. And then that 2-year lease recently came up and was due. So, of course, my mom gets to the dealership early. I'm always late because I'm always running from one webinar or another to meet Mom. By the time I got there, Brian had already pulled up a brand new, ugly, red, maroon colored Equinox. And my mom is looking at it, and you can tell my mom's confused. She's like, where's the button to close the tailgate on the back? He's like, oh, that's an upgrade. And she's looking around and she's like, I don't know if I like the look of it. It looks all futuristic. And then she's decided, he's like explaining all the nav and how you push buttons. She's like, I wouldn't know how to use this. My mom's a very simple woman, doesn't want all the tech, just wants just enough, right? And I basically said to Brian, I said, so I looked at the sticker, I said, this is how much you're selling these things for? And I was, I think by now, any of you that know me, I'm kind of direct. I'm like, this thing's ugly and it's just a giant piece of plastic. Like they put no detail into this thing. It's awful, Brian. And anyway, but let me stop that story there because we're going to get into the whole story of how my mom finally became her own bank. We're going to go through the mathematics. Now, remember, my mom is a simple woman. She's got a life insurance policy that I sold her, a whole life policy. I sold her way back when I was a financial advisor, just a regular off-the-shelf whole life. So we're going to do a 2-part thing here. Okay, I'm going to show you how Mom bought her Equinox, but how much money she's going to make by buying her car. Buying a car is probably one of the worst financial decisions because they all lose money, right? You buy the new car or used car, and what does it do the second you roll it off the lot? It decreases in value. The longer you drive it, the more it needs repairs and tires and brakes and all those things. And every single day of every single month of every single year, your car gets to be worth less. Now, I know some of us are like, wait, hold on, Chris. During COVID, my car went up in value. Yep, let's look at the timeline, and let's look at that little sliver of time. That will be the only time for the rest of your life that will ever happen. It was a rare, weird supply and demand issue, but it probably won't happen. And I love it. Tess says she hasn't bought a new car since 2013. 2013 cars are just fine. But all of you buy cars the same way. Now, some of you have kind of got out of the rat race, and you've read my little booklet called Drifting Away from Traditional Car Buying, and you've learned how to buy cars by being your own bank. But for the most part, most of you are just like my mom. You know of 3 ways to buy cars, maybe 4 for some of you. Hopefully we don't have any of you on here that steal cars. All I can tell you is I never stole my mom's car. I never took it on a joyride, but my friend Jack, my best friend Jack, and I did steal his parents' car. And we went out and we went mud bogging in their car. And he hit a mailbox. I'll never forget it. He didn't know what he was going to do. He was crying. We drove the car to his dad's car wash. We washed it all up thinking, oh, the magic wash, car wash would get rid of all the scrapes and the scratches from hitting the mailbox. It didn't. Yeah, he got in a lot of trouble. I didn't. I was just the co-pilot. I didn't know what the hell was going on. He told me it was his car. I'm just kidding. But anyway, yes, you could steal cars, but most of you lease cars, pay cash for a car, or you finance a car with a bank or finance company, right? To which all of them, you are financing that vehicle. Even when you pay cash, because you are still financing the car when you pay cash for it, because that money that you paid cash for, remember you bought a you bought a car that's going to decline in value, so that money can no longer work for you. It's the same as financing. There is a cost for paying cash for a car. If you lease a car like mom, you make a payment every month, my mom's example, 2 years, and then after the 2 years, you got to give the car back, or you got to buy the car out, right? So every payment in a lease is gone forever. That's probably the most expensive way you can buy a car is to lease it. But you see, we are in this society where the way we look at buying cars is by the payment. How do I get the best car for the lowest payment? Regardless of what the outcome is and the worst case financial decision is, that's the goal. Lowest payment for best car. But in a lease, you give all the money back. You're renting the car. At least when you finance the car, you're just giving up interest and then you're getting a depreciating vehicle. But I'm going to show you how you change the entire game. And I'm going to show that by sharing my mom's story. So let me pull this up. I'm going to do this with slides because I got all the info here. Disclaimer, the content in these webinars reflect personal opinions and are not financial advice, legal advice, tax advice. These are hypothetical scenarios. Actually, this one's not really that hypothetical. But yeah, actual results will vary, subject to underwriting factors, blah, 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 blah. Any questions on the disclaimer? All right, good. Back to the story about Dad. I'll never forget when I was probably 5, 6 years old. We were out in the backyard tilling the garden. Dad always had a beer in his hand. And if any of you have ever heard, my dad, most of my life, my dad was an alcoholic. He did beat it, almost died doing it, but he's, never had a drink since. But Dad, one day I said to him, Dad, I'm thirsty. So he handed me his Budweiser, and I took a sip of it, and I spit it out, and I said, who in the world could drink this shit? I didn't say shit. I would have got probably smacked. But anyway, that's Dad. In the middle is me and my mom, and then over here is Vivi and my mom, and they were catching roosters. It was kind of fun over at Andy's house. But anyway, enough of the family thing. Let's get into this here. So this is actually the invoice from my mom's lease buyout. So she's got herself an Equinox that she was buying out, and you can see all the extras that they do in there. Now, granted, my mom wanted to make sure that if she ever broke down, she's got that warranty. So you got the warranty on there, $5,336. Total purchase price with the warranty, $26,800. But then mom needed to pay tax on that. She needed registration, DMV verify fee, which they charge you to verify. They should just have systems that do that. But anyway, right there, roughly $29,171.26. Now, here's the first thing we did. Now, and I would recommend all of you do the same. When we saw the total buyout with all these extras, what I did is I said, Brian, can you pull up your whole dealership, which they have lots of dealerships, and pull up this year Equinox with similar mileage, and let's just see what they're selling for. Now, the good news was all the used cars that he pulled up were selling for more than what my mom's car could be bought out for, which was $21,464. Remember, if you buy a used car, you only get a warranty. My mom's car has 1 year left on her warranty, but we bought a 5-year warranty. So all things considered, my mom did pretty good buying out her lease. Plus, my mom loved this car and hated the new Equinox, didn't like the Traverse, and definitely did not, and she couldn't afford the Traverse, and definitely did not like the Blazers, to which I found out, they're discontinuing the Blazers. Useless knowledge. So the first thing we did is we went in, and my mom, at first I had to explain to her, Mom, we're going to buy this car using a loan from your New York Life policy. Now, my mom knew how to take loans because we've taken loans from mom's policy, paid off credit cards, and then made the payments back to repay the loan. But my mom, no joke, my mom loves it when the loans are paid back to her policy. So she takes a lot of pride in the fact that by paying the loans back, the max death benefit's there so that if anything ever happened to her, me and Vivi would get the death benefit. I'm like, Mom, let's just buy a car. Forget about worrying about the death benefit. Let's just buy the car. Because as you all know, if you take a loan from your policy, which I'll show you in a second, $29,171 would be her death benefit would be reduced by the amount of the loan. Everybody knows that, right? So what we did is we determined that the interest rate had to be north of 5.25. Now, how did we determine this? When I went to my mom's policy, we had to take a loan from mom's policy. Now, my mom's whole life insurance policy has an interest rate that they will charge on her loans. The interest rate's 5.25. So what we basically had to do is say, okay, I went to Brian and I said, Brian, if we were to finance this through GM Financial, and I know you need to pull her credit score, but don't do that, what would be a pretty good rate that you guys would finance this at? So we had Brian run the financing options. 7.4% was the interest rate they would charge, and I'll show you that in just a moment when we get into my mom's note. Loan interest rate that the finance company would have charged her would have been about 7.43%. So what we figured out is, okay, Mom, if you would pay them 4.7 or 7.4 some percent, if you pay GM Finance for that, why wouldn't you just pay yourself back the same amount? So that's what we said. So now by doing that, if she's paying 5.25 to take a loan from her policy and she's repaying herself back at 7 point some percent, she'd be making a spread. But here's the thing you all don't know. My mom's policy was started way back in 2008. That's a long time. My mom's policy is incredibly efficient, which we'll look at in just a second. But first thing I want to get you to all understand is if you're going to be your own bank, there are rules to this game. And the rules are every time you're going to take a loan from your policy, your money has to go out and work for you at a higher rate than the cost of capital. In this case, the cost of capital is 5.25. That is the loan interest rate. That is simple interest charged on the loan you take from the policy. My mom has to pay that on this loan, but she only gets charged interest one time per year. That is very important. New York Life charges her interest on this loan one time per year. Now, in doing that, what we had to do is we had to figure out Brian, the car salesman, can Brian finance this vehicle through GM Financial to hit mom's goal of a $400 monthly payment? Because my mom was paying $400 for the lease. My mom can't afford and doesn't want to pay more than $400. So right there, my mom got to see that even if she wanted to buy this car and finance it through GM Financial, her payment would have been significantly more than what she was leasing it for. You're right, Paul. It's like 20 years, whatever it is, but we'll look at that. So this is how we did it. We did it right there. We did a loan calculator, entered $29,171.26. That was the auto price, as I showed you a second ago. We got all the stuff down. We put the payment, the down payment to zero because mom doesn't want to come out of pocket at all for this car. And then right there. And we began with an interest rate of 5.5. Why 5.5? A spread. Remember, I said New York Life would charge her 5.25. So we want to just make sure that she just makes a spread. Now, I'm not trying to make a ton of money on the spread because this is my mom's own car, right? So we can play with these numbers, but the rule is my money has to be working for me, my mom's money. Let's reframe this. My mom's money has to be working for her at a rate higher than the cost of capital. The cost of capital is 5.25, so we just bumped it up to 5.5. Stay as close to the minimum as required. Because hey, listen, if my mom owns a bank, why should my mom not get a better rate than she would with GM Financial? She should. She owns the bank, right? But everybody got it. Paul nailed it. A borrowing rate spread. Now remember, if we take a loan from mom's policy for $29,000, let me go back one here. Actually, we'll just leave it here. $29,000 loan from her policy, all of her money, her cash value, which is $51,225, all of it, even though she takes $29,000 out, is still earning interest and dividends at New York Life. And New York Life, I think, is paying right around 6% dividend crediting rate. But my mom has had this policy since 2008. So she's making way more, okay? She's got a much bigger spread, which I'm going to show you in a second. But I just wanted to show you how we met the target premium, or the target payment for mom's car. Let me go back one. We ran a whole bunch of scenarios. We started at 60 months. 60 months at 5.5 was $557.20, too high. 72 months, $476.60 a month, still above target. 84 months, $419.19 a month. Closer, but slightly high. 90 months, $396.29 a month. Slightly below the 400 target. And then I'll just come to the bottom. We finalized this deal at 89 months. Mom's payment, $399.89 a month, meeting mom's payment goal. Does anyone see a problem with this at all? Okay, mom's car is a, what year is it? 2024, I think? I think it's a 2024 Equinox. She is financing this, or at least running the numbers, at 89 months. That's a long time. That's right, Kevin. It's a forever payment. What do you think the likeliness of mom keeping this car for 89 months is? Slim to none. Well, actually, hold on. I don't want to put that past my mom. My mom probably could do it. 7 years and 5 months, right, Paul? So 7 years and 5 months. So in 7 years, this car will be a 7, 8, 9.5-year-old car. My mom loves this car. That is very feasible to think that my mom will keep this car for that long. But I would still say it's unlikely. We'll probably go back and get a new car somewhere in the midst of this. But when you own the bank, do you not have the ability to set the terms any way you want? Now, GM Financial wouldn't have done this. They couldn't have done this. But we could. And you know why it doesn't matter? It's because every bit of that payment is going back to my mom. My mom is keeping 100% of the money now, except for the 5.25, but we already factored that out, right? So $399.89 is all going back to her policy. We already know what the spread is, okay? 5.25 to 5.5. It's a 1/4% spread. Yes, we're not talking about the Fed's 1/4%. This is my mom's money, not what the Fed just did. So here we go. Here's the loan structure. This is my mom's actual note. So on the Vault software, I want to let all of you know that there is a promissory note sample that is just like this one. Okay, so the Vault software provides this in all the calculators and all the stuff to figure all of this out for you if you wanted to at BYOBvault.com. But you can see here's all the numbers, 5.5% interest. That's the finance charge. I want to really, really, really hyper focus on that finance charge right here. $6,418.99. Over 89 months, if mom pays $399.89, that's how much interest she keeps, not how much she gives away. When you look at financing a car, if she did this through GM Financial, this money would be gone forever. Now, this is mom's money. Mom keeps that money, okay? Because it goes back into her payment in her car. So yes, she pays $35,590 if she keeps the car for 89 months, but that doesn't really matter, does it? Because she's the bank. So therefore, she's just paying herself back with interest instead of paying them back with interest. It's a big difference, folks. A really big difference. All right, let's keep going with this. And if any questions come in, if any of you want to know anything, because I am going quick, because you're going to get a double whammy. You're getting my mom's car here, but then we're going to be talking about Marius and how he did this. But here's mom's policy, okay? As you can tell, this wasn't made up. This is actually her policy. 2008. Her death benefit's $129. That's what she was so worried about. Her premium is $275.50 a month. This is just a normal, off-the-shelf, whole life insurance policy. Now, I want to preface that because we don't design off-the-shelf we don't do off-the-shelf whole life policies, do we? We do specially designed and engineered high cash value policies. But here's the funny thing. If we compared mom's policy if we compare that next to one of the high cash value policies, and we look at the same amount of years elapsed, the high cash value policy would clearly have more money, but it wouldn't really get a better return so much more than this. Because here's mom's numbers, right? Her premium's $3,125. So let's do the math. That's how much it is. $3,125 is how much she puts into the policy per year. What we did here is we figured out how much mom made this year. Okay, mom made $2,500. You can see it. It's right there, highlighted. Her guaranteed cash value increased $2,500. So just her interest on the $51,000 was $2,500. But on top of that, she also got a dividend. Her dividend this year was $2,282.22. So she made $2,500 in interest, $2,282 in dividend. The combination of these two is called the dividend crediting rate, $4,700 $4,782.22. That's how much money my mom made. Now, if you do that, but you subtract, we take that, the $4,782.22. Whoops, got too many numbers here. $4,782.22. That's what she made. Divide that into her premium that she paid, $31.25. Now remember, the dividend and the guaranteed cash value increase, those don't account for new premium going in. If I was doing this where I was subtracting last year's cash value from this year, it'd be even more. But New York Life does a good job on their illustrations and just shows just the dividend and just the guaranteed growth, okay? So you can see that on there. So my mom technically made 150% that year. That's her cash on cash return. But here, a lot of you don't want to do that, and probably not right on my mom's because my mom doesn't like taking loans. So let's do this math real quick and follow along with me. And Craig, Stephen, if you want to put this in the chat, my mom's policy, 2025 minus 2008, is 17 years old. So 17 years times 3,125 is what she's paid. My mom has paid into her policy $53,125. My mom has a net cash value of $51,220. Is this a good policy or not? Most of you, if you've seen any of our designs, would say no, not at all. Because for 17 years, mom paid $3,125. She put in more money than what she's gotten back. How many of you think that any of the policies that we design, that would be the case? It's not. That's the difference. And I wanted to preface that because when you see Marius's plan and his example, it will look very different. This is a normal off-the-shelf whole life. It is not designed for efficiency. It's a huge difference, Shane said. Absolutely. That's okay. Because for what mom's going to be using this for, which she bought this policy for the death benefit. That is it. But now mom gets to use this policy to buy her car. Okay, so she bought her car taking a loan from her policy. Regardless of whether or not she made money cumulatively, she will make money in the grand scheme of her banking policy because now, how much money is she getting back from the financing? $6,418.99. That's the finance charge she would have given away if she used their bank, GM Financial. But now, because she's using her bank, she's paying that back to herself. So therefore, even though my mom's underwater cumulatively, if you roll the interest she's going to make on financing her own car back in, she's ahead. She's now made money. But more importantly, she didn't give up any money to the bank. And that's the most important part of this. I want to come over here and I just want to show you, when we look at her policy again, the base plan guaranteed cash value, right here, $34,300. The cash value of paid up additions was $16,644. Premiums paid June 25th, so they just got 1 month in there, so $51,220. So all I'm doing is I'm just showing you right here that this is how much. And you know, Dave Ramsey always says, if you die, you don't get the cash value. Dave Ramsey's right. Dave Ramsey is right. But what you do get is you get the benefit of the cash value or the dividend produced from the cash value. And I did this because I wanted to prove Dave Ramsey wrong. Right here, clear as day. The 2025 dividend credited to your policy, the dividend of $2,282.22 purchased $3,976 of increased death benefit. So Dave Ramsey always says that, you know, you don't get your cash value, which he's right. Mom does not get $129,275 plus the 51, but mom gets, or well, I shouldn't say mom, when mom graduates, I get $129,275, but this policy did not start at $129,000. Base plan death benefit $100,000. So right there on the screen, that's how much mom's policy was in 2008 when we started it. But because of all the dividends and the increase in the cash value, it has pushed her death benefit up to $129,000. So has the cash value helped mom get more death benefit? Yes. Is the death benefit a combination of this $129,000 plus the $51,000? No. But the $51,000 has pushed her death benefit up to $129,000. I just want to hit that. Kind of useless knowledge, but it debunks what Dave Ramsey always says. He's not right. Not right at all. So that's mom's scenario. the reason I wanted to say that and show that, and let me stop sharing here, and we'll go over to Marius with this, is because Americans buy 9 to 13 cars in their lifetime. So 9 to 13 cars every American will buy. So if you just did that basic math times my mom's little example here, and remember, I did my mom's loan at 5.5, so it would be even more than this. But that means if you did the math, my mom, just assuming this scenario, if she bought 9 cars in her life and she financed them all at about 5.5 or about the same price for each car, she would have given away during her lifetime $57,762 in interest. That's only 9 cars. Most folks are not buying cars like this. They're buying more expensive cars. They're giving way more interest. They're buying more than 9 to 13 cars. They're not just buying cars for themselves. They're buying cars for their kids and their spouses and everything else. So how much money do we give up in a lifetime just in interest for buying cars? Well, the low side would be 57,000 to probably, I don't know, $1 million. Think about that. That's insane because most people have not learned how to become their own bank. Most people simply finance cars because most people pay interest to someone else's bank and they lose interest that they could have earned. All we did with moms, and yes, it took my mom time to build up and capitalize her policy, but all we did is we just made her the bank. My mom doesn't even know how to do this. You know, and before a couple months ago, I would have said that's something every one of you have to learn. You have to learn how to become the bank. You have to learn how to do these things I just showed you. But now with the Vault software, you really don't have to learn it. You just need to know what you want to accomplish. So if someone on here said, hey, Chris, that's all good and great, but I don't know how to do a promissory note. I don't know how to do all that math you were just doing. But I'd love to get all the money back for every car I buy, drive, and own. Great. We have created software called the Vault that does all of that for you. So IBC in the future is going to be a lot different than IBC in the past. Because IBC in the past, you had to change your perception around money. You had to actually implement these processes. You had to do all this work. Now the Vault pretty much does 90% of everything I just showed you, and you can figure it all out right there. And you know what? Coming soon, some of you might even be like, well, I don't know how to use software. Chris, you couldn't even figure out how to play a PowerPoint, let alone use software. Okay, great. What if somebody else did it for you? What if it was just done for you? That's coming soon. So with that being said, I'm going to stop and make sure, I don't think we have any questions, but I want to flip this over to Marius because he's got a really cool scenario, and I'm just not going to steal his thunder. I'm just going to let him tell you everything about how he was introduced to IBC, how he used IBC for his, oh, you need to share, hang on one sec, how he used IBC, his first policy, to buy a car and what that looked like for him. All right, Marius, you got it?
Absolutely. Let's get to it. So, made a similar presentation, almost to the one with your mom's. And if you guys don't know me, my name is Marius. I live in the Buffalo, New York area as well with Chris, and we just absolutely love it here. And so this is where, we got a little disclaimer here. And so here you're looking at two people that have used the infinite banking concept to finance their own cars.
Hey,
There's
I
Chris.
know that guy.
Yeah, yeah, there he is. And so, yeah, I went with the 2021 Genesis G70. They're really nice cars. I like the way it drives. It's almost looking like the Aston Martin or Bentley logo. So, whatever. Fake it till you make it. Looks awesome, though. It's a great vehicle. So here's the proof in the pudding here where I took out a loan from my own policy, and you'll see I'd actually put $500 down. I was looking all around in New York. There wasn't any cars I really wanted, especially living in Buffalo. I just wanted something all-wheel drive. So, I was looking everywhere, and I actually found one in Virginia for a really great deal. And so I spoke to the representative, and I had to put $500 down just for him to hold it. So I'd use my credit card for that. But you'll see that's the total amount due, the 24,488.75. But the amount to be financed, that 23,988.75 is the amount I'm going to take from my policy loan because I had to put that $500 down. And now we're going to take a look at my policy. So, Chris, this actually was a policy that I think he didn't know that you were in the infinite banking world, and this was just a policy that was set up more. It's a traditional whole life insurance policy where it is all base and it's not doesn't have the high early cash value.
Yeah,
But
Marius,
it is
this would be just like my mom's policy. Like you
right,
put 5 grand in, see the first year you only had 1,500. That would have been very similar to mom's.
right, exactly. So this just goes to show though, where, I was putting money into this policy and, my stepfather was just like, hey, I just read this book about whole life. Just do it. Trust me, you're gonna like it in the end. So I was like, all right, let's do it. And so after, learning about infinite banking, reading the Nelson Nash book and being around the Chris Naugle campfire, I was like, okay, I've had this policy for a long time and, how can I use it? And I needed a car. And so you'll see right off the bat, this is my policy. So in year 10, you'll see I've put in $50,000 into my policy. And so this is just a 10 pay where after the 10th year, I don't have to put anything else into my own policy. And it just still, continues to compound and grow. I did miss the opportunity of the more of a cash on cash return perspective of how we design the policies of where every dollar I put in, I'm going to be able to keep on taking more out and more out. But you'll see after the year 10, that's where I have the opportunity to start more policies and keep that process going. And so I'm in this year 7 where you're going to see some negatives in the cumulative return. You're going to see some negatives in the cash on cash return. And this is where we were just pointing out that's going to be a more of a traditional off the shelf whole life insurance policy. But just like Chris, you were showing with your mom's policy, down the road, it still gets efficient and efficient down the road. And you'll see this cash value growth keep on continuing and growing and growing and growing. And now I'm not putting anything else into it after year 11. And this cash value growth is still going on whether I take a loan out or not. So even when I take a loan out, my money in the policy is still growing uninterrupted and compounding for the rest of my life. And it just keeps on getting better and better and better and better. And this is all just a little sneak peek as well into the Vault software. I took some screenshots from this, Chris. And so now we'll see, all right, let's see how in control I really am, financing my own system back into my own private banking system. And so the annual interest rate for my policy loan was 5.52. Here's the total amount I took out for my policy, the $23,988.75. If I'm going to be making, say, let's just do 250 a month. Say if I did this an example, only 250 bucks right back into my own system. Since it is a simple interest loan, which is going to be tackling right on the principal, this annual interest rate, well, I don't really look at that at the moment since I want to be an honest banker and pay my own system back. The effective interest rate is going to be 2.90. I've only been putting 250 right back into my own system.
Hang
Now,
on, Marius, real quick.
hmm,
This is such a key thing. Uh, Craig, I just want to give you a chance to kind of explain this because this is some mathematics that oftentimes are overlooked, and we always kind of go right over it because it's hard to explain. But like, you just heard some numbers there, and if all of you were paying attention, hopefully you were. He didn't pay the interest rate of 5.52%. He paid an effective APR. The interest rate he actually paid was 2.9. Craig, can you just unpack that a little bit?
Yeah, and as Marius was sharing, it's a simple interest loan. And so if you're familiar with HELOCs or lines of credit, typically you're making those contributions, payments into your line of credit, and it's 100% going to the principal. Now, the policy loans have a little bit of a different way they handle the interest, which is an advantage to you. So every time Marius puts 250 in towards his policy loan, 100% of that $250 is reducing principal. Then they calculate the interest on that new principal balance and set it to the side. Just like Chris shared earlier, his mom gets charged interest one time a year. Marius gets charged one time a year. So what is Marius doing every time he's making, being an honest banker, making premium or making loan payments back to his own system is he's reducing the principal, which reduces the interest cost. And so I think Marius, when you were planning this out, you said, "Hey, I've got 250 to put towards my loan right now. It's going to take 10 years to pay it off,
mm,
but the actual effective interest rate is 2.9, not 5.52."
right. And so, yeah, you'll see almost kind of in the similar presentation you did, Chris, for your mom, it's going to number of payments, 125 payments it's going to take, but This is just going to show in the next slide where, hey, I'm actually really in total control of how and when I pay my own system back. So say if I flipped it, actually I want to put 500 a month into my own system. I'm the bank. I'm in total control of how and when I pay my system back. And so say it's still 5.52. Now instead I'm putting 500 a month in instead of that 250. Now the number of payments goes to 54. You'll just see right off the bat the effective APR, the interest rate, 2.73. That starts dropping and dropping. And
And
this
Marius,
is
can
not
you
even,
can you go back one slide? I wanted to see what that
yeah,
interest cost was on your 250.
yep,
So by increasing your payment, that's kind of showing the interest going from 72.58 to what, 29?
yep, yep. It's
That's
absolutely
massive.
incredible.
Such a
It's
huge
insane.
difference.
And this isn't even counting what's going on uninterrupted in the policy. And so that's what we can look at on this next slide is, all right, say if I just met myself in the middle, since I'm in total control and, sometimes life happens and expenses come out of nowhere. Say if I even just went to $302.26, still doing that 5.52 annual interest rate with my policy for my 2021 Genesis G70. The profit from the interest arbitrage alone, doing this process of being an honest banker, I just made $6,535.30 from that interest arbitrage alone, paying my own system back, being an honest banker, and with that uninterrupted compounding interest that's going on in the policy, whether they take out a loan out or not, it's just incredible.
So Marius, I just had a thought. Might be kind of cool. Can you go back one slide because that interest cost you had on the
Hmm.
previous side was at 2,900,
Yep.
and now go back. So keep that number in mind, 2,900. Go back to your policy where you're showing your policy
Hmm.
and look at the growth. What's the growth in year eight? It's 62.71.
Yep.
So it's kind of cool that your interest cost was 2,900, but yet your policy still grew 62.71.
That's right. Uninterrupted compounding.
Are you interested in selling this policy?
I'm gonna keep it going.
All right. Sorry, I
Uh,
just kind of I
Couple of
wanted
things about that. That is interesting. I'm glad you brought that up because remember my mom's policy after all those years, she wasn't efficient. What you don't know, my mom has diabetes, not insulin dependent, but she has diabetes. She has a heart murmur. So my mom's rating on that policy, even back in 2008, was, I can't remember what she got rated, but it's definitely not a preferred. It's like a standard or even a sub, like it might just be a class case. So my mom did not have a good underwriting at all, where Marius did. And you can see the big difference that underwriting makes and age.
mhm.
yeah.
You are kind of young, Marius.
Yeah, 23 years.
But the other
Oh,
thing too here is like, for even for yours or my mom's, how we talked about like the length of the duration of the loan, you were trying to kind of make it work for a payment like my mom was. Like it doesn't matter how long you go in duration, even if you don't keep the car, because you control the banking function in your life, folks, especially in this case, like Marius's or my mom's. When Marius wants to get a new car, likely what Marius is going to do is sell that car or he's going to trade that car in. Remember, he's got a ton of equity in that car because he's the bank. He's not leaking anything, so he's not upside down in interest. So when he trades the car in, he gets all that value back toward the next car, which then he finances forward again. So if he just kept doing that, just kept buying cars and then trading them in on new cars and using his bank, he still continues to get all the money back for every single car. Because see, the thing we always teach that I think maybe might have been lost in translation here is we always teach you get all the money back for every car you buy, drive, and own. But what we're saying actually is you get all the money back for every car you buy, drive, and own without ever having to sell the car, without ever having to sell the car. In this case, like even if like Marius decided in 2 years to sell this car, and let's say the car depreciated terribly, which I doubt Genesis is, do, but let's say it did. Even if he did that and the car was way upside down, he still gets all the money back because he's got all the value in the car. That's a very important thing that you need to take in consideration.
absolutely. And so you'll see right in the vault, I made a little promissory note to myself, and it's like, all right, I'm going to pay my own system back. I'm making that promise. It's going to go right back into my own private banking system. I have my payment schedule all ready to go if I want to continue doing that $302.26 a month right back into my own system. And the great part about it is if I miss a couple of payments back to myself, that's okay. Nobody's coming to repo my car. I'm in total control of how I pay my own system back. Maybe Craig and Chris, you might come repo my car, but
Yeah, I will. I'll come in. If you don't make those payments, we're coming to get it.
right.
That's what somebody was just saying. Like, somebody was like, what if things got rough and, like all of a sudden I couldn't make my loan repayment that I set up? And your loan repayment is, where's your dollar amount there?
302, 26.
302,
Let's say
26.
Marius can't make that loan repayment. Like, if he had to make a decision, do I make the premium payment on the policy or premium deposit on the policy or the loan repayment? It's always the premium deposit because that keeps the policy going and moving forward. He's the bank. He can just catch up on those payments later. He can defer those payments. Like, you don't have to ask anybody. You don't have to go to the bank, call the bank, get on hold, talk to AI for 15 minutes just to get to the right place. You literally just say, I need a break from these payments for a couple months till I get back on my feet.
Mhm.
Man, being the bank is awesome.
It's great. And so you'll see just on the policy loan management, you'll see I took out that loan of the $23,988.75. And I still had some cash value sitting into my policy, a little over 6,000. So I just have it there as well, just to have for an emergency fund. I just need to just use it to take another loan out for something. So it's always great to just obviously keep that in my own system as well. And so you'll see that available cash value, it's at 22%. And so now the total car payments, which I'll have that payment coming up soon in October this month. And so this is where my accurate numbers are of I started at 250. I'm a total control. So I was like, all right, let's bump it up to 500. And so in total car payments I paid back into my own system was 2,750. And so we'll see now I have that ledger going right back up to now where I just went from, I think it was 22% or 21%. Now I'm back up to that 31%, able to reuse that cash value as well. If any other expenses come up out of nowhere, my cash value is going right back up, paying to my own system back. I'm over time getting all the money back for the car I drive.
And Marius, I think that's a really, really, really important point to stress because you started the loan, you had what, 6,000 something available,
Mm-hmm.
and then you made $2,750 of payments back to your system, and that actually increased your cash value by 2,750,
Mm-hmm.
made it available again. So that's really that's one thing that people need to realize is when you're making that car payment, it's going back into your pocket. It's not going to the dealer. It's not going to the bank. It's filling up your cash value again.
Right.
That's awesome. Okay.
And so, well, once I pay my own system back, now what do I do? I got all this cash value sitting in my policy. What do I do with it? Well, I think I'm going to head over to privatemoneyclub.com and look at some, maybe some lending opportunities, some real estate deals. And I'm looking at this right here, right off the bat. There's someone looking at a $15,000 for a lending opportunity. Well, let's put that money to work at another spot. So now I have the opportunity to start making money twice on the same dollar, where it's going up once in my policy, guaranteed to compound and grow for the rest of my life. Now I could put that money to work, and now having a cash flowing asset that can go right back into my own system and keep on wealth building and wealth building through that whole process and build more policies, more real estate deals, and more cash flow. I think that sounds a lot better of an idea than just praying to the Lord and Savior that my financial advisor tells me I'm going to have all this money to retire when I'm 60 years old. I'd rather just start now and keep the process going.
Come on, Marius. You want to buy term and invest the difference.
I don't know. Yeah, they say that's the best way to go. Just buy term and then trust that financial advisor. Just praying to God, I'm gonna have all these funds when I'm 60 years old.
Hey, I want to do something fun here. There's another thing that we always teach. I know we just showed it using the policy, but Gloria on here was like, "Oh, this isn't going to work. I'm too old." And listen, for some of you, this wouldn't work because of age. Like if you're in your late 70s and your 80s, this wouldn't work. But here's a unique thing, and we teach this all the time. What if somebody else made your car payments for you? Well, let's just pick a number. I don't know. Marius, just stay right on the screen. Do you have any more deals on there that you could show, or is that just a screenshot?
Oh, yeah, it's just a screenshot.
Okay, here, let me, we teach this all the time. Steven has like a whole presentation on this. I just love it. Literally getting somebody else to pay for your deal. Let's just start with that first one right there. 15 grand, right? Like that's a small one. So let's just say somebody wanted a newer car, and they were strapped for money. They didn't have it, but they had some money sitting aside, right? You have money in a bank account, money in a CD. Let's use 15,000 bucks. So, Craig, can you do the math for me? 15,000 in this deal, which is a 6-month deal at 15% interest. What would that give you per month? So 15%, 15,000.
187.50.
187.50. Okay, so I don't know what kind of car you can get for 187.50, but not many. Let's keep going. Let's keep fishing here. Scroll down. Let's find another deal, like anything around 30,000. Let's do that 45. 45, 30-year note, 60. Oh, wow. All right. So, and I'm just picking random deals. Obviously, there's underwriting. You'd want to go in, you'd want to, underwrite it, review the deal, review the people. But I'm just showing you the math behind this. What would that give me? 40 grand at 16%. How much per month would that give me?
600.
Oh, that's a nice car. So 600 a month. So I think right there we can kind of figure out that the sweet spot would be like 20 to 30 grand to get us to like what Marius's car was, a $300 a month payment. But like right here, if somebody couldn't get the policy and do this, but they wanted somebody else to make their car payment for them, they could lend money on Private Money Club. Like if you had 40 grand sitting somewhere, I don't know where, brokerage account, CD, maybe just sitting in the bank, letting them use your money to do this. If you did that at 16% interest, that would give you a $600 a month payment that the borrower would be making to you. Then you could take that 600. Marius, how much was your car? 302?
Yep, 302.26.
Okay, because that's a really nice car. So now what somebody did is they started with 40 grand, they lent it out at 16, they did all the underwriting, made sure this deal fit their needs and goals, maybe had their advisor or consultant look at it, whatever. And then all of a sudden they come up, they get 600 a month. They go buy a car like Marius's for 302.26. Now they don't just make 600 and get their car paid for them. They got a little extra money, like 298. I'm just rounding, about 298 bucks per month left over to take their family out to dinner every month. That isn't such a bad deal. Not bad at all. Yeah, Paul, you could do it from a HELOC. You could do it from an old policy like my mom's. I mean, anything. I mean, that's kind of Marius. I wasn't thinking that way. And then Gloria put that up in there. I'm like, oh, hold my beer. Let me show Gloria how to do this. Yeah, the policy maybe doesn't work. And Gloria at 74, I'll tell you right now, it does work. I mean, Maureen just said 72 now to retire, I think. At 74 years old, we have a bunch of clients in their 70s that are doing this. You might want to look at it. It probably wouldn't work as good as what Marius is, or might be similar to my mom's, but nonetheless, that's just another option on how you could do it.
And Craig, I actually like your story about how you used your policy for your daughter's car, right? How
Yep.
you can, you're keeping the money in the family.
Yeah, she had the opportunity to finance somewhere else, but we'll use our own banking system, and then she'll just make payments to the bank of dad. And we do have a couple missed payments, so I might be hooking up the truck this weekend.
Here, actually, I want to do this again. Hang on. Somebody just asked another question. Sometimes you guys challenge me. And the thing is like everything we do is math here. So this isn't a hard equation. So let's just say somebody wants to buy a car, and we'll just put 300 bucks a month, just to keep this simple. They got a house that they live in, and they go out and they get themselves a home equity line of credit, and they've got $40,000 available in that home equity line of credit. Now, let's just say that home equity line, Craig, I'm going to need some math skills here from you, is 8%. So to provide this, what they basically do is they need about, let's just do 30,000. Okay. They find a deal on Private Money Club that's paying, we're just going to do 15%. And let's just say they're looking for 30,000 bucks first lien. These deals exist on PMC. I'm just making this one up, but how much would that give them how much would that be per month, Craig? 30,000 bucks at 15.
375.
Perfect. Nice guess, but we kind of did that with that last example. So we know that if we were to lend on this deal in first lien position at a 15% interest rate with 30 grand, we get 375. The main goal of what we're looking to do is we want to basically borrow money, okay? Or we want somebody else to pay for the car. So what we then do, we borrowed 30 grand from our HELOC at 8%. How much would that be per month?
Let's just say 200.
200. All right. So we're not going to pencil here because now We take 30 grand out, we lend it out at 15, we're making 375, but 200 goes back in. So now we've only got $175 a month net. But what this did is now this interest that we're paying gives us 175, but then pays the $200 a month back to the home equity line of credit. So the interest is covered. When the deal pays off, the 30 grand goes back, makes the HELOC full. But in the middle of this, we just made a spread of 175, which could be used to offset a car payment. So you can see if we just pencil the numbers and we just keep doing the numbers here, because I mean, look, that's a pretty inexpensive car. You're now paying 125, if I think I did my math right, 125 a month instead of 300 a month because you're making a spread on the equity in your house. Now that's just a small example. And you could just run the math. In the Vault software does all this as well. You could run the math to figure out what would you need to earn to cover not just the interest on the home equity line of credit, but also the full payment of the car.
And it gets even better too if you're velocity banking with that HELOC and running all your income, paying your expenses out, you're going to buy that interest cost down even faster. So, but yeah, I mean, this is a worst case picture what you just drew up there.
And listen, we're just spitballing
Yep.
here. You can see, like,
Yep.
I didn't have any of these numbers figured out. This wasn't done in the vault. We didn't plan this, but this is kind of how you start to think when you become the bank. You literally just start thinking about, how do I not pay for things? How do I let somebody else pay for everything? How do I be the bank and recapture all the money that I was giving away? Like, this is how you start to think. The biggest problem we've seen, like I mentioned earlier, is a lot of people, they want this, they want the result, they want to pay off their debt. They want to, lend money out and have that pay for their car. They want to do all these things, but they just don't know how. The first time ever, now software is how. You just learn simple, easy to use software and it does it all for you. So, Stephen, we always leave you out on these things and I always feel bad. But I know that you've bought several cars. Have you bought any of your cars, like that Porsche?
Yep.
Didn't you have like a Jeep with giant tires or something? You had a lot of cars.
Don't worry about me over here. I'm good, but it's good to see everybody. Thanks for having me on. I'm always in the background, paying attention, watching the chat, listening, make sure if I can add anything. But yeah, I mean, I've said this before openly. I'm not great when it comes to tracking all of this stuff, so I'm not very meticulous like a lot of you guys are with making sure that every dollar is repaid perfectly. I use my system more freely, almost like a bucket of money, I guess, so to say. And when I need it, I take it. When I have extra, I put it back in and I let it flow that way. And I reconsolidation maybe quarterly. I might consolidate everything and make sure it's all good to go. But it's just my style. I'm not into the whole monthly being the perfect banker, I guess, so to say. But I guess that's the beauty of the system. You can use it how you want it. But yeah, I had 6 vehicles. Just a few months ago. I'm down to 3 right now, plus my boat. But my most recent purchase was my boat, I guess, just a few months back.
Boat, and then also you've got your office space.
Right now, I've been putting a lot of money into my office, correct?
Yeah, so we got his office here. Just trying to give you some visuals. This is Stephen's office overhang, and then it's got a bar out here.
And then I'm always keeping I'm always keeping some money in and available for opportunities too.
Yeah. So all Stephen's saying is he builds up money, he takes his cash, his savings, puts it into the policy, takes that money, uses it for things like buying boats, remodeling and doing his whole office space. But he doesn't really have like a calculation. He didn't do the boat and say, oh, the boat's going to be $300 a month. He just says, I had the money to buy the boat, so I bought the boat. But now the question,
and I do that, Chris, I do that because I know the system works. Like I know how it works. I know how it functions. I know what my money's doing in the policy. I know what I would be paying in interest. So I don't care to track the extra money I'm making by using the system. I just know it's working. So to me, it's like, it's a mental thing where I don't spend the extra time to do that. Now that could be terrible. That might be wrong of me. I'm just sharing with you guys how I do it.
listen, as far as I know, listen, we teach like the mechanics of it and everything, but there is no right or wrong way as long as you're following the rules. Rule number 1, keep 10% of the money you make. Okay, that's the first law of wealth, or save money. Law number 2, keep your money in motion. Make your money work for you, which you're doing. You're buying boats, office spaces. And law number 3, be an honest banker, recycle, and recapture be
A
interested in.
100%, Chris. And that's why over the years, as my income has increased, I've added policies to continue keeping that amount going towards those as my finances increase. And so, yeah, somebody said, you trust, you just don't force it. I trust the system. I know how it works. And it's a beautiful thing. So at the end of the day, I have more money that's always growing for me. I'm in a better financial position to giving all that interest to the banks and to the finance companies. And I know God forbid something happens to me, I know my family's covered into the future, and I know what it's going to do down the road. I mean, I started a policy for my son who just turned 10 years old a few weeks ago when he was, I think, 5. So we've had it for 4 or 5 years now. And I mean, just what that's going to do for him as he gets into buying a vehicle when he turns 16 years old and gets to college and then and beyond when he takes over control of it. And we've talked about this so much. It's not even what it does for him financially. It's the education of teaching him how to use that from a very young age. That's where the real power of it is. But thanks for bringing me in though for a minute.
Absolutely. Absolutely. Marius, anything else on yours you want to share?
I think I'm good. I'm just excited to just have more policies and having my money work for me and more opportunities. And I don't know, that guy that told me to buy a term and invest the difference. I don't know if I like that idea.
Well, I think what we're going to do is we're going to take one from Frankie here in the comments, and Marius, yourself, me, and Craig, we're going to go get hats, and it's going to say bean counters, because we're counting the beans. Or Steven, he's just free flowing, right? Like hippie style. He's just going, hey man, life just happens to me, man.
Oh,
all right, right?
stuff.
Cool. I love it. All right. Well, I want to do one other thing. There was an interesting thing that happened when I was in Denver, and I feel remiss that I have to share this. So there was a gentleman out in Denver, great guy. I spent some time with him, got to know him. He owned a roofing company, okay? And if any of you know anything about roofing companies, they need machinery in roofing companies. You need forklifts if you're big enough to pick up all the shingles and load them on the trucks and all this. So he had a bunch of trucks, had forklifts. And when I got into it, he had policies, okay? So he was doing policies, already had, I think, 3 or 4 personal policies. But what I said to him is I said, all right, in your business, because we got out of the personal realm, he understood that. We got into his business. I asked him a question. I said, those forklifts that you have, okay? Now, how does it work with that forklift that you have? And he said, yeah, we finance them. And I said, how much are you paying on that? He said, well, they're charging 10%. Isn't this cool? Look I got bugs making art. Got a forklift, 10%, and let's just call that $1,000, which I think is about what he was paying. And then he had a bunch of trucks for his business, to which how he bought all those was cash. So how it would work is in his business, okay, this is his business, he's got a whole bunch of cash from his operations, and he doesn't spend it all every single month. So what he does at the end of the year, his CPA says, hey, we got a little bit of a tax thing we got to take care of. The Trump big beautiful bill gives you 100% bonus depreciation on any vehicle that you're going to use for business over 6,000 pounds. He says, oh, my trucks are over 6,000 pounds. So the CPA says, well, go buy some trucks. So what he does, takes cash, goes and buys trucks, lets them roll, trades them in, does that. How many of you love that idea, right? From a tax standpoint, that makes sense, right? Get the depreciation, yada, 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 all that good stuff. Okay. And then the forklift, I just asked him, I said, did you just do this all the time? He says, yeah, we go through forklifts, we need to upgrade them all the time. And it's just like the trucks. We just trade them in, we get new ones, but we finance those. So what I said to him, I said, what if we did 2 different things? There's 2 ways to look at this. In your business, you've got all this cash that you paid, that cash for the truck. And as soon as you pay for the truck, that cash is gone forever, and you just bought a vehicle that will literally depreciate tremendously. So what if we just create a company-owned, we call these COLIs, a company-owned policy? Okay, you're the insured, Mr. Business Owner, because if you die, this company needs a lot of money to replace you, hire a CEO, probably hire a bunch of people just to replace that owner, because the owner knows all the stuff in the business. So this COLI policy, number 1, is going to give us a death benefit, and he's partners with his wife. So I said, do you think your wife would be upset if you had more death benefit? He said, no, she'd probably love it. And then outside of that, you got all this cash value. Then what we do, as soon as we start the policy and we move the cash in his bank account, so let me write this down here, he's got if any of you know what a balance sheet is, it's basically just a listing of all a company's assets, liabilities, and net worth. Think of it as so you got cash on the balance sheet, which is money in the bank. So let's say he's got 100K, But then on the balance sheet, he's got cash value. And let's just say that's 100K. So it's no different. Same dollars on the balance sheet. He just moved where it was. But now what he does is he takes the money to buy the truck out of the policy. And we're going to do a little bit of what Steven said. Free form. Okay, we're just going to go for it. We know how it works. We're just going to go for it. So every single month, his business is putting money into the policy, and then he's buying trucks with this money. Okay, he's not doing any payments back, but he's just taking money from the business, throwing it through here, buying the trucks. Is he better off there even though he's not recycling and recapturing money? 100%. We could show you all the math. We've done this over and over. Because, like what Steven said, as long as you're filling your bank and moving the money, all of the money in the policy is earning interest and dividends. So if he put 100 grand in there and he took, let's just say he took 80 grand out to buy a truck, that 100 grand in cash value is still earning interest and dividends. So he's still earning all the money on it, even though he bought the truck. So that's that issue. And now here's what I said to him. Why would somebody do it that way? Well, somebody would do it through their business because they don't want to pay tax. It's quite simple. They got all this money in their business, but if they take that money out personally to do a personal policy, they got to pay tax on that money. It's called a distribution. So he didn't want to pay tax. He's like, I just leave it in the company, and that way I don't pay tax. I get, at the end of the year, we figure it out, we spend it, blah, blah, blah. He's going to do exactly the same thing he's doing now. Exact same thing. End of the year, CPA is going to say, hey, you need to buy some more trucks to get that bonus depreciation, blah, blah, blah. He's going to go into not his bank account. He's going to go into his policy, his specially designed whole life, and he's going to take loans from his policy to buy the trucks. He's just going to keep filling the policies up every year. But then I said to him, hey, wait a second. You got all these personal policies. So over here, let's go over to the personal policies. I said, what are you using those for? And he says, nothing really yet. I said, do you have a lot of cash value in there? And he said, yeah. So I said, all right, why don't we do this? Why don't we take a loan? Let's just say this forklift, let's say he owes 80 grand on this forklift, okay? He's paying $1,000 a month, 10% interest. So what he does is he takes a loan from his policy for $80,000. Now let's say his policy is 5.25% interest. We'll just use that, okay? That's his interest the insurance company is going to charge. That money goes into his bank account. So this is his traditional bank. We call this a segregated bank, okay? Then he or someone in his office or the vault goes in and creates a promissory note. So this is making it legal. And if he was paying their bank 10%, how much should he pay his bank? 10%. Maybe 8, 9 if he wanted economic value. If he was paying their bank $1,000 a month, should he pay himself $1,000? Yep. If you borrowed from your bank, if you owned a bank, you would make deposits in your bank. I promise you, you would. Okay? If you owned a bank and you needed a loan, you would take a loan from your bank. And if you borrowed from your bank, I almost guarantee you would repay your bank because that's just the right thing to do. You would never steal from your own bank. Nelson Nash calls that don't steal the peace. So here, he does a promissory note. He then goes into bill pay in his company. So now his company gets a check for $80,000. That 80 grand came from his policy. So now in his checking account in his business, he gets 80 grand. He goes and writes a check, pays off this forklift loan, sets up a bill pay back to himself for $1,000 a month. So $1,000 a month is now paid back into his bank account. So $1,000 comes in here, and then he recycles and recaptures that money up here. The vault will eventually have this capability, but this is what's called a loan repayment form. So we fill one of those out. It's one page for $1,000 a month. So the money hits his bank account on the 5th. On the 15th of every month, whatever insurance company sweeps that money from his segregated account, puts it back in the policy. How much money now, Marius, I'll pick on you, does he have in his policy? $1,000, right?
Sorry, yep.
So if he set a bill pay up from his company for $1,000, and then he swept that $1,000 over here, as soon as the $1,000 hits his policy as a loan repayment, he's got $1,000 available. So he lost no liquidity of the money. But now what he did is he's now earning 10% on his 80 grand that he took out. But he's not just earning the 10%, because it's 10, we could do it this way, we could do 10 minus 5.25, so he's making 4.75%. Before he was making nothing on that. He's now making 4.75 plus, if he's earning a dividend crediting rate of 6%, he's earning whatever interest and dividends the policy is paying him net. So he's making money twice on the same dollar. The money right now, today, for this person was actually just sitting there. I showed him this and he's like, that's brilliant. I love that. And he also loved the one with the policy. He's going to do that as well. So I just wanted to show you a different way to look at this from a business standpoint, because we're talking about cars, but we're talking about my mom's personal car, Marius's personal car. Here, we're talking about trucks used for business, trucks that you're getting tax deductions for, and trucks that you're now getting all the money back for. But now you're not just getting all the money back, you're actually making a bunch of money, because it's money your company was giving away to this forklift finance company or the car finance company, or just not earning anything because they're buying vehicles that depreciate in value. I think these things are so important. And I said it before, and I'll say it again. I'll just actually read it. If you own a bank, would you borrow from any other bank than yours? You wouldn't. Like, why? Why would you ever borrow from, if you, like, sometimes you got to think this way. It's so mental. Think as if you physically owned a bank, if you closed your eyes and in your mind, on the corner in your town, you envisioned a bank, and that bank had your name on it. That was your bank. You set that up. You went through all the hard work of building a bank and getting customers for your bank. If you needed to borrow money, would you go to any other bank other than yours? Matter of fact, you wouldn't, because if you did, everybody in the town would know, and they would be like, why are you borrowing from Bank of America instead of your bank? Oh, Bank of America had a lower loan interest rate. Guess what all your customers do? Go to Bank of America. You'd never do that. You got to be an honest banker, though. Even in Stephen's loose, all right kind of scenario, he's being an honest banker. He's always repaying himself. Maybe not as structured as Marius or my mom or the way I do it or the way Craig does it, but still always repaying his own bank. This is how simple this is. Literally, you got to save money, you got to get your money working for you, and you got to be an honest banker and recapture the money. Like, you should never let their bank hold your money. Like, when you look at your bank accounts, if there's a whole bunch of money sitting in someone else's bank, start questioning that. Why am I letting Bank of America, KeyBank, Chase, why am I letting them hang on to all my money? That's a question you got to answer for yourself.
I did, Chris, just to add to that too, I did recently, instead of just being completely free flowing, I did decide that I was taking a portion of mine and over the next 6 months, I'd pay it completely off. And I did it with auto monthly payments going to the insurance company to pay down the loan. So I got that set up. So I'm starting to take advantage of some of this stuff.
I like that.
I'm just not tracking it yet with the vault, which that's my next step.
Well, yeah, but I mean, listen, I bet you, what do we got? We got 135 people on here. I bet you a lot of these folks are using the infinite banking concept, but I bet you a lot of them are doing it very much like you. They just won't admit it. I'm not going to put them on the spot like I did you. I bet you a lot of them are like, yeah, I do that Stephen thing too. It's kind of just like, it's my money, it's my bank. I'm an honest banker, but I don't really have it all written down. Like, I wrote it down on a Post-it note, but that probably got eaten by the dog. Now the vault literally just does it all for you. Yeah. And the vault is just going to get better and better and better. It's going to make things easier and easier and easier. And eventually in the vault, we will have tracking. So you could have 50 loans and it just tracks them all, notifies you if something's going wrong, all these good things. It's all coming. Technology is so amazing and AI is so amazing that literally, like, you don't need to learn how to be your own bank anymore. You need to conceptually just accept the fact that, yeah, I want to pay my debt off. Yeah, I don't want to pay the bank's interest anymore. I want to pay myself interest. And yeah, I want to get all the money back for cars. And yeah, I want to make money twice on every single dollar. If you can say yeah to any of those things, then the only question is why are you not in the vault? Because the only thing you need to do is just have software run that program for you, right? Think of the Matrix, right? Hey, download that program where I can kick 50,000 times in 1 second, or I can dodge bullets, right? You just download the program. Like, you just download the program. It's just called the vault, and just plug in what you want to do. Hey, I want to buy a car today, just like Marius just showed. Great. There you go. Play around with it. Have some fun with it. Hey, I want to wear green sneakers in this video. Yeah. Make it whatever you want. That's all there is to it.
Yeah, and I think the key there was, what Marius was initially showing is planning out his loan. He didn't know exactly what he wanted to do yet, but what if he did 250? What if he did 500? What if he did 302? And then he ended up doing 500. But that's the cool thing about it. You put a plan together that would work for your income, and then guess what? You're putting more into it because it's like, why not? It just all goes back into your pocket. It's taking money from the right pocket, putting it in the left pocket.
Absolutely. Well, I figured we would kind of wrap this up, and actually we're going to finish on time, but I figured I'd wrap it up with Stephen's banking expertise. And I think the best way to show this is right here. So give me a second to load this video up. See, now I get to pick on Stephen once. There we go. All right, make sure you guys can, oh, shoot, hang on. There we go. All right, Craig, make sure I got this correct this time. You see Neo?
There it is.
Yep.
Here we go. That is what it feels like to be your own bank. Stephen, you want to make a quick announcement about some cool things we got going on over there at Money Tank coming up in a few short weeks here?
Yes, 3 weeks out. Money Tank, Orlando, Florida, November 7th and 8th. We got a VIP evening on Thursday the 6th. Still a couple VIP tickets left, but grab your tickets and be there. The room block is sold out, but people are calling and giving the event info. So if you buy a ticket, just email us. We'll give you the number to call. They're still honoring the room block as of just a couple days ago, so you can still try for that. But it's going to be an awesome time. I feel like we keep adding people to it and adding new stuff right now, and it's just getting better and better. So it's gonna be a good time. Right in Orlando, though, right by Universal Studios at Lowe's Resort. And I'll put a link over in the chat box so you guys can grab a ticket if you haven't already. But I know a lot of people come in and are really excited for it.
All right, so folks, remember, as we wrap this episode, it's not about how much you pay. It's about who controls the banking functions in the transaction. So be your own bank. Be like Neo, or should I say be like Stephen, and go out there and take control of your money. With that being said, I really look forward to seeing all of you out at Money Tank. It's going to be an epic time out in Orlando. We just did some new things for all of our VIP attendees. Now, I know there's only like maybe 2 more VIP tickets, but there's another thing that we just added. Shauna came to me and she's like, you know, I think it's cool what we're doing for VIP, but this is what people are asking for. I want to do this thing, doing this thing, but it's going to cost this thing. Can I do it? And I said, yep, as long as it makes the experience better. So you guys are all going to see the thing that does the thing that does the thing at Money Tank out there in Orlando. That is if you get your tickets. So grab your ticket right now. Grab one of the VIP tickets for a really epic 2-day VIP experience. And we will see you then. Thanks, everybody.